All right, let's cut to the chase because we all know that feeling. Tax season. You're staring at those forms, maybe a little bewildered, and the big question looming in your mind is always, how can I possibly keep more of my money this year?
Uh-huh. That feeling is universal.
Well, today we're not just scratching the surface. We're taking a deep dive into one of the most powerful tax-saving opportunities out there for working individuals and families, the Earned Income Credit, or EIC.
Yes, the EIC. It's a big one.
Think of it as a crucial piece of your 2024 tax puzzle that could put significant real money back in your pocket.
That's exactly right. Our mission today is to, well, pull back the curtain on the EIC. We're going to demystify its requirements, explain precisely how it works, and distill the most critical details directly from IRS Publication
Well,
596.
good stuff. Pub 596 is the key source here.
It is. And this isn't about becoming a tax expert overnight. It's about giving you the shortcut to understanding if you qualify for this potentially life-changing tax benefit and, crucially, how to claim it effectively.
Yeah, because knowing is half the battle.
It really is. It's a credit genuinely designed to support lower to moderate income earners. And for many, it can be a real financial game changer.
So let's unpack this right away.
Right.
What is the Earned Income Credit, fundamentally?
Yeah.
And why should everyone listening care about it so much when it comes to their wallet?
Okay, so what's truly fascinating here, and often misunderstood, is that the EIC isn't merely a tax deduction, it's a tax credit.
Right, and that difference is huge, isn't it?
It's absolutely pivotal for your finances. To put it simply, a deduction just reduces your taxable income, which might lower your tax bill a bit. But a credit directly reduces the amount of tax you owe dollar for dollar.
Dollar for dollar. So if you're looking at a tax bill of, say, $800 and you qualify for an $800 EIC,
Poof, your tax bill instantly drops to zero. It's incredibly powerful.
wow. Yeah.
It is. And here's where it gets even more interesting. The EIC is what we call a refundable credit.
Refundable. What does that mean in practice?
It means you could actually receive money back from the IRS, even if you didn't owe any tax to begin with, or, if the credit amount you qualify for is larger than the tax you owe.
So you could owe zero tax, but still get a check from the IRS because of the EIC.
Exactly. It's not just about reducing a bill, it's about a direct financial boost, putting cash straight into your bank account. It's truly designed to provide tangible financial support to working individuals and families whose earnings fall below specific thresholds.
Okay, so when we talk about tax savings with the EIC, we're not just talking about shaving a few dollars off your bill. We're talking about potentially transforming a tax liability into a welcome refund.
That's the potential, yes.
That's a proactive way to manage your finances at tax time, turning what can often feel like a confusing, tedious form into a genuinely beneficial outcome. It's about optimizing your financial picture.
Absolutely. It's one of the most significant tools for financial support for those with lower to moderate incomes. And for your 2024 taxes, it's important to be aware that the earned income amounts, the specific thresholds that determine your eligibility and credit amount, have been updated.
Okay, so the numbers aren't the same as last year.
Correct. This means the landscape has shifted a bit, and perhaps more people might qualify, or the credit amounts themselves could be different than in previous years. Always check the current year's figures.
That's a critical update to note. And just to highlight the IRS's commitment to making this information accessible, you mentioned Publication 596, but they also have resources on irs.gov in multiple languages,
They
right?
do. Beyond English, irs.gov offers information in Spanish, Chinese, Korean, Russian, and Vietnamese. They really strive to ensure everyone has the opportunity to understand and claim what they're entitled to.
That's great to know.
Which brings us to the core question. How do you know if you even qualify? The IRS has laid out a clear set of rules. We're going to begin by diving into what we call the universal rules for everyone.
Universal rules. Okay.
These are the first 7 foundational requirements. You must meet all of these to even be considered for the EIC. Think of it as a crucial checklist. If any one of these doesn't apply to your situation, you won't qualify for the credit. No EIC.
Got it. 7 hurdles to clear first. So let's begin. Rule number 1.
Rule number 1 is all about your adjusted gross income, or AGI, and its limits.
AGI. Okay, for those who might not be entirely familiar, AGI is essentially your gross income minus certain deductions. It's a key figure on your tax return. Where do you find it?
You'll find it clearly stated on Form 1040 or 1040 SR, typically on line 11. It's a straightforward number to locate on the form.
Line 11. Easy enough.
That's right. And for 2024, the AGI thresholds vary quite a bit depending on your filing status and significantly the number of qualifying children you have.
So it's not just one income number for everyone.
Not at all. And the key takeaway on income is that the EIC isn't a fixed amount. It phases in and then phases out based on your income. This means there's a kind of sweet spot where you get the maximum benefit. And earning just a little more can sometimes surprisingly reduce your credit. It makes proactive planning and careful income tracking really crucial if you're near those phase-out points.
So what are the general ranges for these AGI limits? Just ballpark figures for 2024.
Okay, so roughly speaking, for someone filing single with no qualifying children, your AGI must be less than $18,591.
$18,591. Okay.
If you're married filing jointly with no kids, that limit goes up to $25,511.
$25,511. Married, no kids.
Right. Now add one qualifying child, single filer limit is less than $49,084. Married filing jointly, less than $56,004.
84 single, 56,004 married with one kid.
Yes. Two qualifying children, less than $55,768 if single, or $62,688 married, two kids.
And finally, 3 or more qualifying children, less than $59,899 if single, or $66,899 if single, or $66,890 if married, filing jointly.
$59,899 single, $66,819 married, 3 plus kids. Wow, those ranges are quite specific. They are. And you'll absolutely want to check the exact numbers on irs.gov or in Publication 596 for your specific situation. But the main point is these thresholds depend heavily on your family size and filing status.
Let's use a real-world example to make this concrete. Imagine Jamie Smith. Jamie is single, has no children, and their adjusted gross income for 2024 is $24,400.
Okay, Jamie, single, no kids, AGI $24,400.
Right. Now, we just said for a single person with no qualifying child, the AGI limit is less than $18,591.
Correct.
So in Jamie's case, their AGI of $24,400 is simply too high.
Exactly. It's over the limit. So unfortunately, Jamie cannot claim the EIC. This example clearly shows how critical these income limits are.
But wait, you mentioned filing status matters. What if Jamie's situation was different?
Good point. If Jamie's filing status was, hypothetically, married filing jointly, and the combined AGI with their spouse was still $24,400,
Okay.
they might have qualified. That's because the married filing jointly limit for no qualifying child is $25,511. Their $24,400 AGI would be under that limit.
Ah. So being married filing jointly could have pushed them under the threshold. Filing status makes a substantial difference.
It absolutely can. Now, a quick important note about community property laws. This gets a little technical.
Okay, community property. Let's hear it.
If you're married but filing separately under those special rules for living apart, and you happen to reside in a community property state, your AGI for this rule would include your portion of both yours and your spouse's community income.
So even filing separately, some of your spouse's income counts towards your AGI limit in those states.
For the AGI limit rule, yes. It's a bit different from how community property affects earned income for Rule 7, which we'll discuss in a moment. Just a heads up for folks in those states.
Got it. Community property adds a wrinkle. Okay, that was Rule 1, AGI limits. What's Rule 2?
Rule 2. You must have a valid Social Security number, or SSN.
Seems simple enough. Who needs one?
You, your spouse, if you're filing jointly, and any qualifying child you're claiming for the EIC must all have a valid SSN by the due date of your 2024 return, and that includes any extensions you might have filed.
Okay, valid SSN. This sounds pretty straightforward, but I imagine there are specific situations where people get tripped up on what makes an SSN valid for EIC.
You're right to ask that. The critical insight here is its validity for work. An SSN is generally valid for EIC purposes unless, well, a couple of things. First, if it was issued after the due date of your return.
Okay, timing matters.
And second, crucially, if it was issued solely for the purpose of applying for or receiving a federally funded benefit like Medicaid, and the card says not valid for employment, if it has that legend, it generally doesn't authorize you to work and isn't valid for EIC.
Not valid for employment. That's the key phrase to look for on the card.
Yes. But there's an important exception. If your SSN card initially said, not valid for employment, but your immigration status has since changed, maybe you became a U.S. citizen or a lawful permanent resident, you should ask the Social Security Administration, the SSA, for a new card without that legend.
Okay, so you can get it updated.
Right. And you can claim EIC if you became eligible for a work valid card by the tax return due date, even if you hadn't physically received the updated card yet. The eligibility date is what counts.
So the key is the underlying work authorization tied to the SSN, not just having the number itself. What happens if an SSN is missing, incorrect, or doesn't meet these validity criteria?
If an SSN for you, your spouse, or your child is missing or incorrect or not valid for work, your EIC claim will likely be denied. Straight up. And here's a critical point. If an SSN for you or your spouse was missing because it wasn't valid by the original due date, maybe you were waiting on that status change, and you happen to get a valid one after that due date, you generally can't file an amended return to claim the EIC for that past year. The number had to be valid by the deadline.
So you can't retroactively claim it if the SSN wasn't valid in time.
Generally, no. Also, an individual taxpayer identification number, or ITIN, does not qualify for the EIC. You sometimes see those for folks who need to file taxes but aren't eligible for an SSN. For EIC, it must be a valid SSN.
That's a vital distinction. ITNs are out for EIC. So practical tip. If you're close to the filing deadline and still waiting on an SSN, maybe applying for one or getting an updated one, it might be wise to proactively file Form 4868.
The extension form.
Yeah, for an automatic 6-month extension. Or at least make any electronic payment you owe by the original due date. This buys you more time to get your SSN in order without missing the deadline for other reasons.
That's excellent advice. Proactive planning really is key for tax savings, especially with deadlines like these.
Okay, that's SSNS, Rule 3.
Rule 3 is relatively straightforward, but often important for certain taxpayers. It applies if you are separated from your spouse and not filing a joint return.
Ah, okay. The married filing separately situation, or maybe head of household.
Potentially, yes. To meet this rule, you must meet specific conditions. First, you need to be legally separated according to your state law under a written separation agreement or a decree of separate maintenance.
A formal separation document.
Yes. And second, you must not have lived in the same household as your spouse at the end of 2024. If you meet both these conditions, you'll indicate it by checking a specific box on Schedule EIC, the form we'll talk more about later.
Got it. Legally separated and living apart at year end. What's Rule 4?
Rule 4, you must be a U.S. citizen or a resident alien for the entire year.
Okay, that sounds pretty clear-cut, right? Citizen or resident alien all year long.
Mostly, yes. Straightforward for most. But there's an important exception that can come into play for married couples.
An exception. Do tell.
If you're married filing jointly, a non-resident alien spouse can qualify for the EIC if they choose to be treated as a U.S. resident for tax purposes for the entire year.
They can choose to be treated as a resident. How does that work?
It's an election they can make. However, making this choice has significant implications. It's not a small decision.
Why is that?
Because it means both you and your spouse will then be taxed by the U.S. on your worldwide income, not just U.S. source income.
Worldwide income.
Yeah.
That could be a big drawback depending on their situation.
Absolutely. So it's a decision that requires really careful consideration. You'd likely want to dive deep into IRS Publication 519, which covers U.S. Tax Guide for Aliens, for all the intricate details and potential consequences before making that election.
Definitely sounds like something to weigh carefully. The potential EIC benefit versus the potential tax on global income.
Exactly. It's a trade-off calculation.
Okay. Rule 4. Citizen or resident alien status, with that key exception for non-resident alien spouses filing jointly. Next up, Rule 5.
Rule 5. You cannot file Form 2555.
Form 2555. What is that form for, and why does filing it disqualify you from the EIC?
Good question. Form 2555 is specifically for taxpayers who are living and working abroad. It's used to exclude foreign earned income from their U.S. taxable income or to deduct or exclude foreign housing amounts.
Ah, so it's for expats claiming foreign income benefits.
Precisely. Essentially, if you're claiming these benefits related to earning income outside the U.S., the IRS says you cannot also claim the EIC. The EIC is generally designed to support domestic workers within the U.S. economy.
So it's one or the other, foreign income exclusion, or EIC.
That's the rule. And it's important to remember here, for this particular rule, U.S. territories like Puerto Rico or Guam are not considered foreign countries. So working there doesn't automatically trigger this Form 2555 issue.
Good clarification. Okay, Rule 5, no Form 25555. What's Rule 6?
Rule 6 is another straightforward numerical limit. Your investment income must be $11,600 or less for 2024.
$11,600. That's the cap for investment income.
That's the cap for the 2024 tax year. If your investment income, think interest, dividends, capital gains, things like that, goes above that $11,600 limit, you're out of the running for the EIC. No exceptions there.
Why is there a limit on investment income?
Well, the thinking behind it is that the EIC is fundamentally geared towards supporting individuals who are actively working and earning income from their labor, wages or self-employment. It's less intended for those who might have lower earned income but substantial income from passive investments.
So it keeps the focus on work-based earnings.
Exactly. For example, if we consider Cameron and Jordan Gray, a couple we'll discuss as an example later, they only had $525 in interest income. That's well below this $11,600 limit, so they'd meet this rule easily. It's usually folks with significant investment portfolios who might bump up against this particular limit.
Makes sense. Okay, that brings us to Rule 7, the last of the universal rules. And this sounds like a big one. You must have earned income.
Yes, this is fundamental. You can't get the earned income credit without earned income. This rule specifically defines what income actually counts towards qualifying for the EIC, and it's not always intuitive what falls in or out.
Okay, so what does count as earned income? Let's list it out.
All right. The most common sources are wages, salaries, and tips, basically, the amount reported in Box 1 of your Form W-2.
Box 1 on the W-2. Got it.
It also includes net earnings from self-employment. That's your profit after expenses if you're a freelancer, a gig worker, or run your own small business, usually calculated on Schedule C or sometimes Schedule F for farmers.
Self-employment profit. Check.
Also, gross income received if you're classified as a statutory employee.
Statutory employee.
Yeah.
Right, you mentioned that classification earlier. It's kind of a hybrid.
Sort of, yeah. For tax purposes, they're treated like employees for certain things, like Social Security taxes, even if they operate independently. They get a W-2 with a specific box checked. Their gross income counts here.
Okay. So W-2 wages, self-employment profit, statutory employee income. What else?
Beyond those main ones, it can also include wages paid by you to household employees, if applicable. Also, tips you received but didn't report to your employer.
Unreported tips. Interesting.
Yes. Also, certain Medicaid waiver payments, but only if you elect to include them as earned income for EIC. That's a specific choice you can make.
An election again. Okay.
Taxable dependent care benefits count, and employer-provided adoption benefits reported on Form 8839, and wages shown on Form 8919, which is for uncollected Social Security and Medicare tax on wages. So it's broader than just your standard paycheck.
It definitely covers more than just the basics. Now, you mentioned elections. Are there other special considerations here, especially for military families?
Absolutely. A truly crucial point, especially for military members, is the non-taxable combat pay election.
Combat pay. How does that work with EIC?
Normally, combat pay isn't taxed, but for EIC purposes, you can elect to include your non-taxable combat pay in your earned income calculation. This pay is usually shown on your Form W-2 in Box 12 with code Q.
Why would you choose to include non-taxable income?
Because it can potentially increase your EIC amount. Since the credit amount depends on your earned income level, adding combat pay might push you into a range where you get a larger credit.
It could boost the credit, but could it also hurt?
Yes, that's the crucial part. It could also decrease your EIC if adding the combat pay pushes your income into the phase-out range where the credit starts shrinking. So it requires careful calculation to see if making the election helps or hurts your specific situation.
So you should probably figure it both ways, with and without the combat pay included.
Definitely. That's the best approach. And if you're married and filing jointly and both spouses have combat pay, you can each make separate elections for your own pay. One spouse could include it, the other might not.
Very flexible. That's a valuable tip for military service members and their families. What about disability benefits? Do those count as earned income?
It depends. For disability benefits, if you retired on disability, the taxable benefits you receive under your employer's disability retirement plan are considered earned income.
Okay.
Until you reach your minimum retirement age. That's generally the earliest age you could have received a regular pension or retirement benefit from that plan if you weren't disabled.
So there's an age cutoff.
Exactly. Once you reach that minimum retirement age, those same payments are then considered pensions, not disability payments anymore, and pensions are not earned income for EIC purposes. It's a key distinction based on age and the plan rules.
So disability retirement counts before minimum retirement age, but becomes a pension and doesn't count after.
Correct. Also, disability insurance payments you receive from a policy where you paid the premiums yourself are never considered earned income, regardless of your age.
Good distinction. This brings us to what does not count as earned income. These are common misconceptions that could unintentionally trip people up, right?
Exactly. Knowing what's out is just as important as knowing what's in. because including the wrong type of income could disqualify you or lead to errors.
So was definitely not earned income.
Okay, big categories. Interest and dividends are out. Pensions and annuities are out. Social Security benefits, including disability from Social Security, are out. Railroad retirement benefits, also out.
So passive income and retirement income generally don't count.
Generally, no. Also excluded are alimony and child support payments received, welfare benefits, workers' compensation benefits, unemployment compensation. That's a big one people sometimes confuse.
Unemployment is out. Got it.
Non-taxable foster care payments are out. Veterans benefits, including VA rehabilitation payments, are also not earned income.
Okay.
And a couple of specific exclusions. Earnings you received while you were an inmate in a penal institution,
Yeah.
and non-taxable workfare payments.
That's a pretty comprehensive list of what doesn't count.
Yeah.
It's crucial to get that right. Now let's circle back quickly to community property, but specifically for earned income. You mentioned it was different than for the AGI rule.
Right, good question. It's a subtle but important difference, mainly relevant if you're married, but filing separately under those special rules, or maybe filing as head of household, and you live in a community property state.
Okay. What's the difference for earned income?
For earned income, when calculating the EIC in that specific filing situation, your earned income for the credit does not include any amount earned by your spouse that is legally treated as belonging to you under state community property laws.
So even if state law says half your spouse's wages are technically yours.
For EIC earned income calculation in this specific context, you only count your own actual earnings, your W-2 wages, your net self-employment income, etc. It doesn't pull in the community property share of your spouse's earnings for this calculation. It focuses solely on your work contribution.
Interesting. So for the AGI limit, community property income is included, but for the earned income test itself, it's not.
In that specific married filing separately head of household situation, yes, that's the nuance. It's complex, so definitely something to look into carefully if that applies to you.
Okay, wow. So those are the 7 universal rules that apply to everyone seeking the EIC. AGI limits, valid SSN, separation rules, citizenship residency, no Form 2555, investment income limit, and having earned income. If you tick all those boxes, congratulations.
You're on the right track.
Now let's talk about the next layer, which is often where the EIC benefit really grows. Claiming the EIC with a qualifying child. This typically leads to a much higher credit amount.
Yes, this is where potential tax savings really expand for families. If you meet those first 7 rules and you have a qualifying child, there are a few more rules to meet, but the payoff can be significantly larger.
And there's a specific form involved here, right?
Absolutely critical. If you have a qualifying child, you must complete and attach Schedule EIC to your Form 1040 or 1040-SR. This form is how you provide the IRS with all the necessary details about your child name, SSN, relationship, time lived with you.
Schedule EIC, don't forget it. What if the child doesn't have a valid SSN yet?
Still attach Schedule EIC. You provide the information you have. However, be aware, not having a valid SSN for the child by the tax due date will prevent you from getting the higher EIC amount based on that child. And it will likely delay your overall refund while the IRS processes things, but you still need the form attached if you're claiming the child lived with you.
Good to know. So even without the SSN, attach the form. Now, if you don't meet these child-related rules, can you still get EIC?
Yes, potentially. You might still qualify for the self-only EIC, which has its own set of rules we'll cover next. But first, let's nail down these qualifying child rules.
Okay. Rule 8 seems to be the big one here.
Yeah.
Your child must meet the relationship, age, residency, and joint return tests. That's a lot packed into one rule. Let's break it down, starting with the relationship test. Who exactly qualifies as your child for EIC purposes?
The relationship test is pretty broad, actually. It includes your son, daughter, stepchild, or eligible foster child.
Son, daughter, stepchild, foster child. Okay.
Or any descendant of those, think grandchildren, great-grandchildren, and so on.
Descendants count too.
Yes. It also covers your brother, sister, half-brother, half-sister, stepbrother, or stepsister.
Siblings and step-siblings.
And, again, any descendant of those relatives, so your nieces, nephews, grandnieces, etc.
Wow. Okay. So it's not just direct children. What about adoption?
An adopted child is always treated as your own child for these purposes, and that specifically includes any child lawfully placed with you for legal adoption, even if the adoption isn't yet final by the end of the year. The placement for adoption is key.
Placement is enough. Good. Now, you mentioned eligible foster child. What's the specific definition there? Does just taking in a friend's kid count?
Generally, no. For EIC, an eligible foster child is someone placed in your care by an authorized placement agency.
Authorized agency. Like who?
This could be a state or local government agency, like Child Protective Services, or it could be a tax-exempt organization licensed by a state to place children, or an Indian tribal government or an organization authorized by a tribal government. The placement has to be official.
So informal arrangements usually don't count for the foster child definition.
Correct. For example, the IRS publication mentions Dean, age 12. If Dean was placed in your care 2 years ago by an authorized social services agency, Dean is considered your eligible foster child for EIC. But if Dean just came to live with you informally, it wouldn't meet the foster child test.
Got it. Official placement is key for foster children. Okay, that's relationship. Next part of Rule 8, the age test. How old does a child need to be?
Your child must meet one of 3 age criteria at the end of 2024. First, they must be under age 19.
Under 19.
And they must be younger than you, or younger than your spouse if you file jointly.
Under 19, A&D, younger than the taxpayers. Okay, what's the second option?
Second, if they are a student, the age limit goes up. They must be under age 24.
Under 24 if a student.
And again, they must be younger than you or your spouse if filing jointly.
Under 24, student, A&D, younger than the taxpayers. Got it. Third option.
The third option has no upper age limit. The child must be permanently and totally disabled at any time during 2024. If they meet the disability criteria, their age doesn't matter.
Permanently and totally disabled, any age.
Okay.
So, just to illustrate, if your child, Sam, turned 19 on December 10th, 2024, and wasn't a full-time student during the year or disabled, Sam wouldn't be a qualifying child based on age. They weren't under 19 at the end of the year.
Right, because they hit 19 before the year ended. These age rules require precise calculation.
They really do. And don't forget that younger than you part. It can trip people up, especially with siblings or other relatives.
How so? Give me an example. Okay, let's imagine your 23-year-old unmarried sibling, Blake. Blake is a full-time student, lives with you all year, and isn't disabled. You and your spouse are both 21 years old.
Okay, 23-year-old student sibling. We're both 21.
Blake is under 24 and a student, so that part's okay. But is Blake younger than you or your spouse? No. Blake, 23, is older than both of you, 21. So Blake is not your qualifying child.
Ah, because Blake isn't younger than at least one of us.
Exactly. But now, same scenario, but let's say your spouse was 25 years old and you're still 21.
Okay, spouse is 25, I'm 21, Blake is 23.
Now, Blake is younger than your 25-year-old spouse. Since Blake only needs to be younger than one of you when filing jointly, Blake would be your qualifying child in that case, assuming all other tests are met.
That's a crucial nuance. Only needs to be younger than one spouse if filing jointly. Okay, now for the student definition.
Yeah.
What counts? Just being enrolled?
Not quite that simple. To qualify as a student for the age test, your child must be, during some part of each of any 5 calendar months during the year,
5 months.
a full-time student at a school. The 5 calendar months don't have to be consecutive, but they have to be within the calendar year.
Full-time for 5 months. And what counts as a school?
A school needs to have a regular teaching staff, a defined course of study, and a regularly enrolled student body. This typically includes elementary schools, high schools, colleges, universities, and technical, trade, or mechanical schools.
Okay, pretty standard educational institutions. What doesn't count?
This is crucial. On-the-job training courses generally do not count. Neither do correspondence schools or schools offering courses only through the internet. An internet component might be fine if it's part of a regular school program, but an internet-only school usually doesn't qualify for this test.
No online-only schools.
Yeah.
That's a very important distinction in today's world.
Yeah.
Okay, that covers age and student status.
Okay.
Next up in Rule 8, the residency test. Where does a child have to live?
The child must have lived with you in the United States for more than half of 2024.
More than half the year. In the U.S., how is United States defined here?
Specifically for EIC residency, United States means the 50 states and the District of Columbia. It explicitly excludes Puerto Rico and other U.S. territories like Guam or the U.S. Virgin Islands.
Only the 50 states and D.C. Good to know. And what counts as living with you? Does it have to be the same house?
Your home for this purpose can be any location where you regularly live. It doesn't have to be a traditional house or apartment. It could even be a homeless shelter. The IRS is flexible about the type of residence, but it must be in the U.S., 50 states, D.C., for the majority of the year.
More than 6 months physically present in the home.
More than half the year. And there are important exceptions for temporary absences.
Oh, okay. Like, what if a child is away at college? Does that break the residency?
Generally, no. Temporary absences due to special circumstances usually count as time lived with you. This includes absences for illness, education, like college, business, vacation, or military service. Even time spent in juvenile detention can count as a temporary absence.
So a college student living in a dorm most of the year likely still meets the residency test with their parents.
Yes, usually that's considered a temporary absence for education, and their permanent home is still considered to be with the parents.
Are there other special circumstances for residency? Military families? Newborns?
Yes, several. For military families, U.S. military personnel stationed outside the U.S. on extended active duty are considered to live in the U.S. during that duty period for EIC purposes. Extended active duty means being called up for an indefinite period or more than 90 days.
So overseas deployment doesn't break residency for EIC.
Good. Right. If a child was born or sadly died during 2024, they're treated as having lived with you for more than half of 2024 if your home was their home for more than half the time they were alive during the year.
Okay, prorated for the time they were alive.
Exactly. For an adopted child or eligible foster child placed with you during 2024, they're considered to have lived with you for more than half of 2024 if your main home was their main home for more than half the time since they were placed with you in 2024.
Also prorated from the placement date.
Correct. And there are special rules if a child was kidnapped. You'd generally still be able to claim them and would indicate this by entering KC for kidnapped child on Schedule EIC.
Wow, okay. Lots of specific situations covered. This residency test seems really important, and it raises a caution flag, doesn't it?
It absolutely does. You cannot claim the EIC for a child who didn't live with you for more than half of the year, even if you paid all their bills or provided most of their support. The residency test is separate from support.
So paying child support doesn't automatically grant you the EIC for that child if they didn't live with you enough.
Correct. The IRS takes residency very seriously and may ask for proof if they question it.
What kind of proof might they ask for? What should people keep?
They might request documents like school records showing the child's address, medical records, childcare records, letters from schools or healthcare providers, maybe landlord statements, anything that clearly establishes the child lived with you for the required period.
So keeping good address-related records for your child is vital. It protects your claim.
It absolutely can save you a lot of headaches and delays if the IRS asks questions. Record keeping is key.
Okay. Relationship, age, residency. The last part of Rule 8 is the joint return test.
Right. The general rule here is that the child cannot file a joint return with their own spouse for the year you're claiming them.
So if your 18-year-old daughter got married and files jointly with her husband, you generally can't claim her as a qualifying child for EIC.
Generally correct. However, there's a very important exception.
Another exception. Let's hear it.
The exception applies only if the child and their spouse file a joint return solely to claim a refund of income tax withheld or estimated tax paid.
Solely for a refund of withheld tax. How does that play out?
Let's use a couple of IRS examples to make it clear. Example 1. You supported your 18-year-old child who lived with you all year. The child's spouse was in the armed forces and earned, say, $25,000. They file a joint return to report that income and maybe get some benefits.
Okay, standard joint return with income.
In this case, your child is not your qualifying child. The exception doesn't apply because they weren't filing only to get withheld tax back. They had substantial income to report.
Makes sense. What's the scenario where the exception does apply?
Example 2. Imagine your 18-year-old child and their 17-year-old spouse lived with you. They each had part-time jobs, maybe earned only $800 total in wages between them, and had a small amount of tax withheld by their employers. They have no other income and aren't actually required to file a return.
Okay, very low income, just getting back withheld tax.
If they file a joint return only for the purpose of getting that withheld tax refunded, then the exception does apply. In this specific case, your child may still be your qualifying child, assuming all other tests are met. The reason for filing the joint return is the absolute key.
So if they filed that same joint return to claim, say, the American Opportunity Credit for education, even if no tax was withheld,
then the exception would not apply. Claiming a tax credit like the AOTC means they are not filing only for a refund of withheld estimated tax, so they wouldn't be your qualifying child for EIC in that case.
purpose matters. That's
Yeah.
critical. Anything else on married children?
Yes, one more point. Even if your child was married at the end of the year but does not file a joint return, they generally can't be your qualifying child unless you can claim them as a dependent under the regular dependency rules. There's an exception to that if you're divorced or separated and you're letting the child's other parent claim them under those special rules for non-custodial parents. It gets layered.
Okay, dependency rules come into play if the married child doesn't file jointly. And a quick reminder, you mentioned this earlier, for the higher EIC amount based on a qualifying child, that child needs a valid SSN by the due date.
Correct. No valid SSN for the child means you might still get the self-only EIC if you qualify otherwise, but not the larger credit based on having a qualifying child. Exception. If a child was born and died in 2024, you might be able to claim them using a book death certificate instead of an SSN.
Okay, that covers the 4 tests within Rule 8. Phew. Now, Rule 9. Your qualifying child cannot be used by more than one person to claim the EIC. This sounds like where those tiebreaker rules come in, right? This gets really interesting.
Exactly. This is the one child, one claim principle, and it's fundamental across several tax benefits, not just EIC. Sometimes a child might technically meet the tests, relationship, age, residency, to be a qualifying child for more than one person. Think about a child living with a parent and a grandparent, or maybe living part of the year with each separated parent.
Right. Multiple people could potentially claim them.
But the rule is, only one of those persons can actually treat the child as a qualifying child for tax purposes in a given year. And crucially, whoever claims that child gets to use them for all 5 related tax benefits that depend on having a qualifying child.
5 benefits? What are they again?
Okay, the 5 are the Earned Income Credit, EIC, the Child Tax Credit, CTC, and the related Additional Child Tax Credit, ACTC, and Credit for Other Dependents, ODC, Head of Household Filing Status, the Credit for Child and Dependent Care Expenses, and the tax-free exclusion for dependent care benefits provided by an employer.
EIC, CTC, CODC, Head of Household, Child Care Credit, Dependent Care Benefits Exclusion. Got it.
You cannot split these up. If person A claims the child for EIC, person B cannot then claim the same child for the child tax credit, for example. The person who wins the tiebreaker gets the child for all applicable benefits. The only exception is if the other person's your spouse and you're filing a joint return, then you claim the child together.
Okay, so when multiple people could claim the same child and they aren't filing jointly, who wins? How do these tiebreaker rules actually work? Let's get specific.
Right. This is where the IRS lays out a specific hierarchy. For these rules, remember, parent means a biological or adoptive parent. A step-parent or foster parent is generally not considered a parent for tiebreakers unless they legally adopted the child.
Okay, biological or adoptive parent is key. First tiebreaker.
Rule 1. If only one of the people potentially claiming the child is the child's parent, biological or adoptive, the child is treated as the qualifying child of the parent. Parent wins over non-parent.
Parent beats grandparent, aunt, older sibling, etc. Simple enough.
Rule 2. If the parents could claim the child and they file a joint return together, then the child is treated as the qualifying child of the parents on that joint return. Also simple.
Okay. What if the parents don't file jointly, but both parents could potentially claim the child? Maybe they're separated.
Rule 3. If the parents don't file jointly but both claim the child, and the child meets the test for both, the IRS looks at residency time. The child is treated as the qualifying child of the parent with whom the child lived for the longer period of time during the year.
Longer residency wins between parents. What if they lived with each parent for the exact same amount of time, say exactly 6 months each?
Good question. If the child lived with each parent for the exact same amount of time, then the parent who had the higher adjusted gross income, AGI, for the year gets to claim the child.
Higher AGI wins if residency time is equal between parents.
Correct. Rule 4. What if no parent can claim the child as a qualifying child? Maybe the parents don't meet EIC rules themselves, or no parent chooses to claim the child. But multiple other people could claim the child, say, a grandparent and an aunt both qualify.
Okay, multiple non-parents qualify. Who wins then?
In that scenario, the child is treated as the qualifying child of the person among those non-parents who had the highest AGI for the year.
Highest AGI wins among qualifying non-parents if no parent claims.
Exactly. Now, there's one more important nuance here.
Uh-oh. More nuance.
It relates to someone being eligible but maybe not claiming EIC. Let's say you and someone else both have the same qualifying child, but the other person can't claim the EIC. Maybe their income is too high, or they don't meet another EIC rule.
Okay, so they're out for EIC. Can I then claim the child for EIC?
You may be able to, unless that other person, even though ineligible for EIC, still uses the child to claim one of those other 5 tax benefits we listed. Like, if they claim the child tax credit or file as head of household using that child, if they claim any of those benefits, you cannot claim the child for EIC.
Wow. So even if they can't get EIC, if they use the child for CTC or head of household, I still can't claim the child for EIC.
That's the rule. The child can only be used once across all those benefits.
These tiebreakers are critical. Let's run through a few IRS examples to really solidify this. Example 2 from Pub 596, your AGI is $25,000. Your parents, the child's grandparent, AGI is $20,000. You are the child's parent. Who claims?
You do, because you are the child's parent, and the parent wins over a non-parent according to Rule 1 of the tiebreakers. Your AGI doesn't even matter in that comparison.
Parent wins. Okay. Example 3. Similar, both you, parent, and your parent, grandparent, try to claim the same child.
Again, you, as the child's parent, will be the only one allowed to claim the child for EIC and the other related benefits. Your parent's claim, based on that child, will be disallowed by the IRS. Parent priority is strong.
What about splitting kids? Example 4 mentions multiple children. Can parents or taxpayers agree to split them?
Yes, absolutely. If there are multiple children who could potentially be qualifying children for more than one person, the eligible taxpayers can agree on who claims which child. For instance, say you have 3 children living with you and your parent. Maybe your parent has a higher AGI. You could agree that you'll claim one child for EIC if you qualify, and your parent will claim the other 2 for EIC if they qualify, and maybe the child tax credit.
So strategic allocation is possible if multiple kids are involved.
It can be. It allows families to potentially maximize their overall tax benefits.
Now, example 5 brings up a different angle. What if you yourself are a qualifying child of someone else? Can you claim EIC?
This leads directly into Rule 10, but it's crucial for the tiebreakers too. Generally, no. If you are only 18 years old, live with your parent, and meet the tests to be their qualifying child, you cannot claim the EIC yourself. And furthermore, you generally cannot claim your own child as qualifying child for EIC in that situation either.
So if I'm my parent's qualifying child, I can't claim EIC, and I can't claim my own kid for EIC. Who claims my kid then?
Potentially, your parent, the grandparent, might be able to claim your child, their grandchild, as their qualifying child for EIC, assuming the grandchild meets all the tests relative to the grandparent. It's about the hierarchy. The person higher up the family tree who can claim usually takes precedence.
That makes sense. My dependent generally can't claim their own dependent for EIC.
For EIC purposes, basically yes. Now, example 6 touches on the income limits again. If you are the parent, and your parent, the grandparent, also lives in the home but earns, say, $50,000, which is too high for them to claim EIC with the child.
Okay, grandparents' income is too high for EIC.
Then only you, the parent, assuming your income is within the limits, can claim the EIC using the child. The grandparent is out of the running due to their income, clearing the way for you.
So their ineligibility due to income doesn't block me, the parent.
Correct. And example 10 highlights agreement. Say you and your child, Logan's other parent, are unmarried but live together all year with Logan. Maybe you have the higher AGI, so normally the tiebreaker would give you the claim.
Right, higher AGI parent wins if living together equally.
But if you both agree that the other parent, with the lower AGI, should claim Logan, and that other parent does claim Logan for EIC, and you do not claim Logan for any of the 5 tax benefits, then the other parent can claim Logan as their qualifying child.
So a formal or informal agreement between eligible parties can override the basic tiebreaker outcome.
As long as only one person ultimately claims the child for all the benefits, yes. The IRS generally respects the agreement between the parties who could claim the child.
Fascinating. Okay, that covers the tiebreakers in Rule 9. Now for Rule 10, which we've touched on, you cannot be a qualifying child of another person. This feels like a direct consequence of the tiebreakers, but it's important enough to be its own rule.
It is, because this rule applies quite broadly. If you meet the relationship, age, residency, and joint return tests to be someone else's qualifying child, you generally cannot claim the EIC yourself.
And this applies even if the person who could claim you doesn't actually claim you, or even if they don't qualify for EIC themselves.
Yes, that's the kicker. Your status as being a potential qualifying child for someone else is what generally prevents you from claiming EIC for yourself. It doesn't matter if they actually claim you or get any benefit from you.
So let's use an IRS example. You're 22, unmarried, live with your parent all year. You're a full-time student at a trade school, so you meet the under 24 student age test. You earned $5,700 from a part-time job.
In that scenario, you meet all the tests to be a qualifying child of your parent: relationship, age, residency, joint return. Therefore, you cannot claim the EIC yourself, even with your own earnings. Your status as their qualifying child takes precedence.
Even if my parents' income is too high for them to get EIC.
Even then, your status blocks you, however. There's that critical exception again.
The exception related to whether the other person has to file.
Exactly. This is the escape hatch for some people. You are not considered the qualifying child of another taxpayer, and thus may be able to claim EIC yourself if that other person.
Let me guess. He isn't required to file an income tax return. AND either doesn't file or R files a return only to get a refund of withheld income tax or estimated tax paid.
You nailed it. That's the crucial exception. If the person who could claim you falls into that specific category, then you are not treated as their qualifying child for EIC purposes, and the path is open for you to claim it if you meet all the other rules.
So let's use the examples from the publication again. Example 1. Your parent had no gross income at all, wasn't required to file a tax return, and didn't file one.
Then you are not considered their qualifying child for EIC. You could potentially claim EIC yourself.
Example 2. Your parent had wages of only $1,500, had some tax withheld, and filed a return only to get that withholding back. They didn't claim EIC or other credits based on you.
Again, you are not considered their qualifying child. You could potentially claim EIC.
But example 3, same situation. Parent earned $1,500, but they went ahead and did claim the EIC on their return, maybe the self-only EIC.
Now you are considered their qualifying child because they filed a return claiming a benefit, not just for a refund. Therefore, you cannot claim the EIC yourself.
That distinction, filing only for a refund versus filing to claim a benefit, is incredibly important for younger adults or students living at home who might have their own earnings. It could unlock EIC for them.
It's a very significant nuance that can make a real difference in maximizing tax savings for the household overall.
Okay, so we've covered the 7 universal rules and then the extra rules, 8, 9, 10, for claiming EIC with a qualifying child. Now, what if you've gone through all that and determined you don't have a qualifying child? Maybe your kids are grown or someone else is entitled to claim your child under those tiebreaker rules. Are you just out of luck?
Not necessarily. Don't despair. You might still qualify for the self-only EIC, sometimes called the childless EIC. The credit amount is generally smaller than with qualifying children, but it's still valuable. This brings us to the final set of specific rules, rules 11 through 14.
Okay, EIC without a qualifying child. Rule 11.
Rule 11 is about age requirements specifically for the self-only EIC. To qualify, you must be at least age 25, but under age 65 at the end of 2024.
25 to 64, basically. That's the age window.
That's the window. If you're married filing a joint return, the rule is a bit more flexible. Only one spouse needs to meet this age test, 25 to 64. Doesn't matter which spouse, as long as one of you is within that age range at the end of the year.
So if one spouse is 27 and the other is 23, they meet the test because the 27-year-old qualifies.
Exactly. Or if one is 62 and the other is 68, they meet the test because the 62-year-old qualifies, as long as one is in the 25-64 range.
How do you calculate that age exactly? Does turning 25 on December 31st count? Or turning 65?
The IRS precision strikes again. You're considered to reach age 25 on the day before your 25th birthday, but you reach age 65 on your 65th birthday.
Before your 25th, but on your 65th.
Okay. So to meet the test for the 2024 tax year, you must have been born after December 31st, 1959, so you didn't turn 65 during 2024, and before January 2, 2000, so you turned 25 before the end of 2024.
Born after 1/23/159 and before 1/20/2000. That's the specific date range for 2024. What if a spouse died during the year?
If your spouse died in 2024 and you're filing jointly, you meet the age test if you were 25-64 at year end, or if your deceased spouse was 25-64 at their time of death.
Okay, that provides some flexibility in sad circumstances. Rule 11. Age 25-64. What's Rule 12?
Rule 12. You cannot be the dependent of another person.
We talked about dependency before. Does this work the same way? If someone can claim me, I'm out.
Pretty much, yes. If someone can claim you as a dependent on their tax return, according to the dependency rules, you generally cannot claim the EIC for yourself, even the self-only EIC.
Even if they choose not to claim me, that seems like a recurring theme that could cost people money.
It is, and it's a crucial point many people stumble on. Yes, even if they don't actually claim you. The ability for someone else to claim you as a dependent is generally what blocks your EIC claim.
Is there an exception here too?
Yes, the same exception we saw before. You can still claim EIC if the person who could claim you as a dependent isn't required to file an income tax return, A&D either doesn't file, or R files a return only to get a refund of withheld income tax or estimated tax paid.
So let's use the IRS examples again. Example 1. You're 25, single, living at home with your parents. You worked part-time, were a student, earned $7,500. Your parents provide some support, but based on the dependency rules, maybe your income is too high for the qualifying relative test, they cannot claim you as a dependent.
In that case, you meet Rule 12. Since no one can claim you, you're clear on this rule.
Okay. But example 2, same facts, 25, living at home. But maybe you earned only $2,000. Now, your parents can claim you as a dependent, maybe as a qualifying relative. They decide not to, maybe to let you file your own return.
Even though they chose not to claim you, the fact that they could claim you means you don't meet Rule 12. You cannot claim the EIC yourself in that situation. The ability to claim is the key factor for EIC, not whether they actually do.
That's tough. It really highlights the importance of understanding those dependency rules. What about joint returns? Can you be a dependent if you file jointly?
Generally, no. If you're married and file a joint return, you typically cannot be claimed as a dependent by another person, like your parents. However, there's a twist if you file that joint return only to get the EIC. The IRS says that's not considered filing only for a refund. So in that specific case, your parents still can't claim you as a dependent. It's a bit circular.
Okay, the dependency rules interact complexly with filing status. Rule 12, cannot be someone else's dependent. Rule 13.
Rule 13 is essentially a re-emphasis of Rule 10, but applied specifically in the context of qualifying for the self-only EIC. It states, you cannot be a qualifying child of another taxpayer.
So even if I meet the age 25-64 rule, if I also happen to meet the tests to be someone else's qualifying child, relationship, age, residency, joint return relative to them, I still can't get the self-only EIC.
That's exactly right. If you fit the definition of being someone else's qualifying child, that status overrides your ability to claim the self-only EIC. This holds true even if that other person doesn't actually claim you or doesn't meet all the EIC rules themselves, like maybe their income is too high.
Give me an example where this might apply to someone over 25.
Okay, consider someone who is 26 years old but is permanently and totally disabled. They live with their parent all year and maybe earn $5,000 from working at a community center.
Okay, 26, disabled, lives with parent, earns $5K. They meet the 25-64 age rule.
Yes, but because they are permanently and totally disabled, they meet the age test, any age if disabled, to be their parent's qualifying child. Assuming they also meet the relationship, residency, and joint return tests relative to the parent, they are the parent's qualifying child.
The disability makes them a qualifying child regardless of being over 24.
Correct. Therefore, this 26-year-old individual cannot claim the EIC for themselves, even the self-only version, because they are considered someone else's qualifying child.
That's a really significant nuance for individuals with disabilities living with family. Are there exceptions here too?
Yes, the same familiar exception applies. You are not considered the qualifying child of another taxpayer if the person who could claim you as such isn't required to file an income tax return and either doesn't file or files only to get a refund of income tax withheld or estimated tax paid.
Same escape hatch. So if the parent in that last example wasn't required to file and didn't, or only filed for a refund, the 26-year-old disabled person could then potentially claim the EIC themselves.
Yes, exactly. That exception can open the door. The IRS publication provides examples 1, 2, and 3 under Rule 13 that illustrate this exception clearly, mirroring the ones we discussed under Rule 10.
It really pays to understand that filing requirement exception. Okay, Rule 13, cannot be someone else's qualifying child. What's the last rule for the self-only EIC? Rule 14.
Rule 14 is about residency, similar to the rule for qualifying children, but applied to you and your spouse if filing jointly. It states, you must have lived in the United States more than half of the year.
Lived in the U.S. more than half of 2024. Same definition of U.S.
Yes. Your main home and your spouse's, if filing jointly, must have been in one of the 50 states or the District of Columbia for more than half the year. Again, this specifically excludes Puerto Rico, Guam, and other U.S. territories.
And temporary absences. Homeless shelters. Military.
Same principles apply. Homeless shelters can count as a home. Temporary absences generally don't break residency. And U.S. military personnel on extended active duty stationed outside the U.S. are still considered to live in the U.S. for EIC purposes.
Okay, consistent residency rules. So that's Rules 1114 for the self-only EIC, age 25-64, cannot be a dependent, cannot be a qualifying child, and U.S. residency for more than half the year.
Plus, you still need to meet the universal rules 1 through 7 we covered at the beginning, including the AGI and earned income limits for someone with no qualifying children.
Right, those universal rules always apply. Okay, we have covered the eligibility rules in pretty extensive detail. Now let's get to the exciting part, actually figuring and claiming the EIC, putting the numbers together to get that money back, and maybe most importantly, how to avoid pitfalls that could cost you money or cause major headaches later on.
Absolutely. This starts with Rule 15, which isn't really a new rule, but more of a final check on the income limits we discussed way back in Rule 1.
Rule 15. Earned income limits,
Right.
the final hurdle.
It just reiterates that your total earned income, not just your AGI, must also be less than the specific thresholds we outlined. These are the same maximum income numbers as the AGI limits.
So just to quickly recap those maxims again for 2024.
For no qualifying child, earned income less than $18,591 single, or $25,511 married, filing jointly.
Okay.
One child. Less than $49,084 single, or $56,000 for MFJ.
Got it.
Two children. Less than $55,768 single, or $62,688 MFJ.
Yeah.
Three or more children. Less than $59,899 single, or $66,819 MFJ.
And these are the earned income caps, matching the AGI caps. Crucial to remember these specific 2024 numbers have changed.
Very crucial. Always use the current year's figures.
Okay, so once you've confirmed you meet all the applicable rules, universal, maybe child-related, maybe self-only,
Yeah.
and your income is within the limits, how do you actually figure out your specific EIC amount and claim it?
Well, you have a couple of options for figuring the amount. One option is to let the IRS figure the credit for you.
The IRS will calculate it. How does that work?
If you want the IRS to do it, you generally just need to make sure you filled out the rest of your Form 1040 correctly, including attaching Schedule EIC if you have a qualifying child. Then, on the EIC line of Form 1040, line 27, you typically just write EIC on the dotted line next to it, instead of entering an amount. The IRS computers will calculate it based on the info you provided.
That sounds convenient. Any downsides?
The main thing is you should only choose this option if you are absolutely certain you are eligible for the EIC based on all the rules we just discussed. If you aren't eligible and ask the IRS to figure it, it could cause delays or errors. It's convenient, but relies on you knowing you qualify.
So self-assessment of eligibility is still key.
Yeah.
What's the other option? Figuring it yourself.
Yes, you can figure it yourself, which many people prefer just for peace of mind, to know the number up front. The IRS provides detailed EIC worksheets right within the instructions for Form 1040.
EIC worksheets in the 1040 instructions. Are there different worksheets?
Yes, you'll need to determine whether to use EIC Worksheet A or EIC Worksheet B. It depends mainly on whether you had self-employment income or certain other specific types of employment.
Okay, worksheet A versus worksheet B. Who uses A?
Worksheet A is for the simpler situations. You use Worksheet A if you weren't self-employed at any point in 2024, and also if you aren't a member of the clergy, a church employee who has to file Schedule SE, that's the self-employment tax form, or a statutory employee filing Schedule C.
So basically, if your income is primarily from regular W-2 jobs, you probably use worksheet A.
That's generally right. Worksheet B is for those who are self-employed at any time in 2024, meaning you'll likely file a Schedule C or F, or if you are a member of the clergy or a church employee filing Schedule SE, or a statutory employee filing Schedule C.
So self-employed folks, clergy, certain church employees, statutory employees use worksheet B.
Correct. The worksheet instructions guide you through calculating the income figure needed for the next step.
Okay, so you complete the correct worksheet. Then what? How do you get the final credit number?
Once you complete the correct worksheet, A or B, it will point you to the 2024 EIC table, which is also in the Form 1040 instructions, usually near the back.
The EIC table, like the tax tables.
Exactly like that. This table is where you'll find your final credit amount. You'll look up your filing status, single, married, filing jointly, etc., the number of qualifying children you have, 0, 1, 2, 3, or more, and then find the row that includes the income amount you calculated from the worksheet. Where your income row meets your status children column, that's your EIC amount.
Find your income range, cross-reference with filing status and the number of kids, get the credit. It's a systematic process.
Very systematic, designed to lead you to the correct credit based on the rules.
Let's walk through that Cameron and Jordan Gray example again to make this really concrete. Remind us of their situation.
Okay, Cameron and Jordan Gray, they are married filing jointly. They have 2 qualifying children, ages 10 and 8, who lived with them all year and have valid SSNs. Cameron earned W-2 wages of $15,000. Jordan had W-2 wages of $18,030. They also received $525 in interest income. No other income in 2024. Both have valid SSNs.
Okay, married, 2 kids, combined wages $33,030, some interest. They meet the basic rules.
Yes. Their AGI, $33,555, and earned income, $33,030, are both below the limit for married filing jointly with 2 children, $62,688. Their investment income, $525, is below the $11,600 limit. They meet the SSN, citizenship rules, etc.
So they qualify. Now, figuring the credit, which worksheet?
Since their only income is from wages, W-2s, and a little interest, and they aren't self-employed, clergy, etc., they would use EIC Worksheet A.
Worksheet A.
They would follow the steps on Worksheet A, inputting their earned income, $33,030, and potentially their AGI, $33,555 were instructed. The worksheet helps determine which income figure results in the largest credit. Sometimes AGI gives a better result if it's lower than earned income.
So the worksheet helps optimize based on AGI versus earned income.
Exactly. Once they complete Worksheet A, it gives them a final amount to look up in the EIC table.
And then they go to the EIC table.
They find the section for married filing jointly. They look down the income columns to find the row that contains their calculated amount, likely based on their $33,030 earned income, or possibly AGI if lower. Then they look across that row to the column labeled 2 children. The number in that cell is their EIC amount for the year.
Find the income row, go across to the MFJ 2 children column, and bam, there's the credit amount.
That's the process. They then enter that amount on line 27 of their Form 1040.
That's fantastic practical guidance showing exactly how to move from eligibility to the actual credit amount. Now, speaking of forms, a critical reminder. Schedule EIC. You mentioned it before, but let's hammer it home. Do not forget this form.
This cannot be stressed enough. If you are claiming the EIC based on having 1 or more qualifying children, you must complete and attach Schedule EIC to your Form 1040 or 1040 SAR. No exceptions.
Why is it so critical? What's on it?
Schedule EIC is where you provide the IRS with the essential identifying information for each qualifying child. Their full name, their valid Social Security number, their year of birth, whether they were a student or disabled if relevant for the age test, their relationship to you, and the number of months they lived with you during the year.
All the key details to prove they are a qualifying child.
Exactly. Failure to attach this schedule when required will delay your refund. The IRS processing system will flag the return because it expects Schedule EIC when EIC is claimed with children.
So even if it holds things up slightly, attach it even if the child's SSN isn't valid yet.
Yes. You provide the information you have. The lack of a valid SN will prevent the higher credit and cause delays, but omitting the schedule itself when claiming a child lived with you is a separate processing error. Attach the schedule. The IRS will be looking for it.
Got it. Attach Schedule EIC if claiming kids. Now, the flip side. Avoiding trouble. Let's talk about the disallowance of the EIC, covered in Chapter 5 of Publication 596. This sounds like crucial information for protecting your tax savings and avoiding significant headaches.
Yes, this is where things can get serious, and understanding the rules here is vital for long-term financial health. The main thing to know about is Form 8862.
Form 8862, information to claim certain credits after disallowance. When do you need to file this?
You need to file Form 8862 with your tax return if your EIC claim was denied or reduced by the IRS for any reason other than a simple math or clerical error for any tax year after 1996.
Any disallowance after 1996, unless it was just a simple math mistake.
Correct. If the IRS previously examined your return and specifically disallowed the EIC based on you not meeting the eligibility rules, like the qualifying child tests, income limits, etc., you generally need to file Form 8862 the next time you claim the EIC to show the IRS you've corrected the issue and now qualify.
So it's like saying, okay, IRS, I know you denied it before. Here's proof I qualify now.
Essentially, yes. It requires you to explain how you meet the rules you previously failed.
When don't you need Form 8862? What counts as a math or clerical error?
You don't need Form 8862 if your EIC was reduced or denied simply because of, say, incorrect arithmetic on your return. Maybe you looked up the wrong amount in the EIC table, or you forgot to include an SSN for yourself or a child, or transcribed a number incorrectly. If it's an obvious error the IRS can easily spot and fix, Form 8862 usually isn't required for future claims.
But what happens if you are required to file Form 8862 because of a prior non-clerical disallowance and you don't attach it to your current return when claiming EIC?
If you are required to attach Form 8862 and you fail to do so, your EIC claim for the current year will be automatically denied. And interestingly, that specific omission failing to attach a required Form 8862 is considered a math or clerical error by the IRS. You can't fix it just by sending the form later. You have to file it with the return.
So failing to file 8862 when needed leads to automatic denial. Got it. And even if you do file it, the IRS might still ask for more proof.
Yes, attaching Form 8862 doesn't guarantee approval. The IRS may still request additional documents from you to prove your eligibility, like birth certificates, school records, etc. And needing to provide those documents will delay your refund.
Okay, so Form 8862 is key after a prior disallowance. Now, what about the repercussions if your EIC claim was denied due to something more serious than just failing a rule? Like if the IRS determined you were reckless or committed fraud?
This is where the consequences get much more severe and can impact you for years. If the IRS determines your error in claiming EIC was due to reckless or intentional disregard of the EIC rules,
Reckless or intentional disregard.
you cannot claim the EIC for 2 years following the year the final determination of the error is made. There's a 2-year ban.
2 years without EIC. That's significant.
It is, and to claim the EIC again after that 2-year prohibition period ends, you must complete and attach Form 8862 to your return for that year. For example, Pub 596 says, if your 2023 EIC was denied in a final determination made in December 2024 due to reckless disregard, you couldn't claim EIC for tax years 2024 or 2025. You'd need to file Form 8862 with your 2026 return if you qualify then.
Wow. 2 years is a substantial period to lose out on that credit. What about if the error was even worse, if it was due to fraud?
Even more severe. If the IRS determines the error was due to fraud, you cannot claim the EIC for a staggering 10 years.
10 years.
10 years following the year of the final determination. Using a similar example, if your 2023 EIC was denied in December 2024 due to fraud, you couldn't claim EIC for tax years 2024 all the way through 2033. You'd need to file Form 8862 with your 2034 return to try and claim it again.
10 years. That's a massive penalty. Do you have rights if you disagree with these determinations?
Yes, absolutely. If the IRS proposes to deny your EIC and impose these ban periods, they will typically send you a statutory notice of deficiency. You generally have 90 days from the date of that notice to file a petition with the U.S. Tax Court if you disagree. You have appeal rights.
Okay, there's a process to challenge it. But the takeaway seems clear. Getting the EIC rules right is incredibly important, not just for getting the credit this year, but for avoiding these potentially long and costly prohibition periods.
Absolutely. Keeping thorough, accurate records, understanding the rules we've discussed, and claiming the credit properly the first time is truly the best tax-saving strategy in the long run. It avoids these major headaches and protects your access to the credit in future years.
This deep dive into the Earned Income Credit has certainly armed you, the listener, with a much clearer, actionable understanding of this powerful tax credit. But as we've seen, the rules can be complex. Beyond knowing the rules, knowing where to get help is equally important for successfully navigating the tax landscape and ensuring you maximize your tax savings.
Absolutely. And the good news is, the IRS offers excellent free tax preparation options that can be invaluable, especially if you feel overwhelmed or just want a second pair of eyes.
Like what? What are the main free options?
Well, for starters, the IRS has launched Direct File. You can find it at irs.gov Direct File. This is a fantastic new permanent option for filing simple federal tax returns online directly with the IRS, completely for free.
Direct File. Simple federal returns online, free. Does it handle state taxes?
If you live in a state that participates with Direct File, the tool will guide you after you finish your federal return to a state-supported tool where you can prepare and file your state return, often also for free.
That sounds like a potential game changer for a lot of people looking for a simple, totally free way to file both federal and state.
It really could be. Another long-standing option is IRS Free File at irs.gov Free File. This program partners with commercial tax software companies to offer free online software for preparing and filing your federal return if your income is below a certain threshold. Some partners might offer free state filing too, but not all do. Free File also offers fillable forms if your income is higher, but that's basically just electronic versions of paper forms with no guidance.
So free file software for lower moderate incomes, maybe free state, maybe not. Got it. What about in-person help?
For free in-person help, there are 2 main volunteer programs. First, the Volunteer Income Tax Assistance, or VITA program. VITA sites offer free tax help to people who generally make $64,000 or less, persons with disabilities, and limited English-speaking taxpayers who need assistance. Volunteers are IRS certified.
VITA for incomes under $64K, disabilities, language barriers. How do you find a VITA site?
You can find locations and information at irs.gov VITA or by calling the IRS at 800-906-9887 or check the IRS 2Go mobile app.
Okay, and the other volunteer program?
That's the Tax Counseling for the Elderly, or TCE, program. TCE also offers free tax help for all taxpayers, but they give special attention to those who are 60 years of age and older. TCE volunteers are often retired individuals themselves and specialize in answering questions about pensions and retirement-related issues unique to seniors.
TCE. Focus on seniors and retirement issues. Where do you find them?
You can visit irs.gov TCE for details and site locations. Many TCE sites are run by the AARP Foundation's Tax Aid program, and one more free resource specifically for the military community.
Right, military personnel and veterans.
Yes, MilTax. It's a comprehensive free tax service available for U.S. Armed Forces members, including Guard and Reserve, and qualified veterans and their families. It's provided through the Department of Defense via Military OneSource at militaryonesource.mil/MilTax. Includes software and consultant support.
So direct file, free file, VIT, TCE, MilTax, lots of great free options to ensure you claim the EIC and everything else you're entitled to. That's a huge tax-saving tip right there. Don't pay for prep if you qualify for free help.
Exactly. Utilizing these free services can save you preparation fees and help ensure accuracy.
Beyond hands-on help, the IRS website itself is packed with fantastic online tools for proactive tax planning and assistance.
Indeed. We mentioned Pub 596, but for a quick check, there's the EITC Qualification Assistant tool at irs.gov, EIT Assistant. You answer some questions, and it gives you a preliminary idea if you might qualify. It's a great first step.
EITC Assistant for a quick eligibility check. What about planning for next year's taxes?
For that, the tax withholding estimator at irs.gov W4 app is incredibly useful. You input your estimated income, deductions, credits, etc., and it helps you determine the right amount of federal income tax to have withheld from your paychecks throughout the year.
Why is that important for tax saving?
Because getting your withholding right means you avoid giving the government an interest-free loan via too large a refund, or getting hit with a surprise tax bill and possibly underpayment penalties if you withhold too little. It helps you manage your cash flow better all year long, keeping more money in your pocket each paycheck, potentially.
That's a brilliant proactive tax-saving strategy. Adjust your W-4 based on the estimator's result.
Exactly. It puts you in control.
What other general resources on irs.gov are especially helpful?
For common tax questions, the general help page is irs.gov help. For downloading current and prior year forms, publications, and instructions, it's irs.gov forms, or irs.gov forms if you need paper copies mailed.
Forms and publications are easy to find.
And really useful is your IRS online account, accessible at irs.gov account. You can securely log in to see information about your specific federal tax account, like the amount you owe, details of any payment plans, your payment history, view certain notices, and more. It's like having your tax dashboard online.
Online account for personalized info. Good to know. The IRS also offers services to ensure direct communication and accessibility for everyone, right? Language barriers, disabilities.
Yes, they're quite focused on this. For taxpayers with limited English proficiency, they offer a free over-the-phone interpreter OPI service at their Taxpayer Assistance Centers, TAAs, and also at VITCE volunteer sites. This service covers over 350 languages.
Over 350 languages via phone interpretation.
Wow. There's also an accessibility helpline at 833-690-0598 for taxpayers who need information on accessibility products and services like TTY/TDD access or forms in large print.
Accessibility helpline. Good number to have.
Yeah.
And can you request written communication in other languages?
Yes. You can file Schedule LEP, language preference, with your Form 1040 to request that the IRS send you certain written communications, like notices, in your preferred language instead of English. They currently offer several languages, and it may take some time for the change to be fully implemented across all communications.
Schedule LEP for written language preference. Okay. Now, a crucial topic for financial security, especially in today's digital world, protecting your information. Tax-related identity theft is a scary and very real concern.
It is, unfortunately. Tax ID theft happens when someone steals your personal information, most often your social security number, to commit tax fraud. Usually they file a fake tax return using your SSN to claim a fraudulent refund or credit like the EIC in your name.
What's the impact if that happens to you?
It can be a major hassle. Your legitimate refund might be delayed while the IRS sorts things out. You might receive confusing notices about returns you didn't file, and it can take a lot of time and effort working with the IRS Identity Theft Victim Assistance Unit to resolve the situation.
So how do you protect yourself? What are the red flags?
The biggest thing to remember is how the IRS communicates, or rather, how they don't. The IRS will never initiate contact with taxpayers asking for personal or financial information via email, text messages, especially those with weird shortened links, unsolicited phone calls demanding immediate payment or threatening arrest, or through social media channels.
No emails, texts, social media DMs asking for your SSN or bank account.
Absolutely not. If you receive any communication like that claiming to be the IRS, it's almost certainly a scam. Don't click links, don't provide info. You can report scams to the IRS. If you suspect you are a victim of tax ID theft, visit irs.gov identity theft for the official steps to take.
Okay, be wary of unsolicited electronic contact. Is there anything proactive you can do before becoming a victim?
Yes. This is highly recommended. You can voluntarily sign up to get an Identity Protection PN or IPPN from the IRS. Go to irs.go/bppn to learn more and opt in using their secure verification process.
Identity Protection PN or IPPN. What is it?
It's a unique 6-digit number that the IRS assigns to you annually. When you have an IPPN, it acts as a secret key. Your electronic tax return won't be accepted by the IRS systems unless you include your correct current year IPPN along with your SSN. It effectively blocks anyone else from filing a fraudulent return using just your stolen SSN.
So it adds a crucial layer of security specifically for filing your federal return.
Exactly. It's an excellent way to proactively protect your identity and prevent someone else from claiming your refund or credits fraudulently. Highly recommended for anyone concerned about ID theft.
Great tip. Okay, shifting gears slightly. Managing refunds and payments. Once you've filed your return and claimed the EIC, how do you check on your refund status?
The IRS provides several easy ways. The quickest is usually the Where's My Refund tool on the IRS website at irs.gov. You'll need your SSN, filing status, and exact refund amount.
irs.gov refunds? What else?
You can also use the official IRS2Go mobile app, which has the same Where's My Refund feature. Or, if you prefer phone, there's an automated refund hotline you can call at 800-829-1954.
Website, app, or phone line. Now, is there anything special about EIC refunds timing-wise?
Yes, this is incredibly important to manage expectations. By law, the IRS cannot issue refunds before mid-February for any tax return that claims either the Earned Income Credit, EIC, or the Additional Child Tax Credit, ACTC.
Cannot issue before mid-February if EIC or ACTC is claimed. Does that mean just the EIC portion is delayed?
No, crucially, this applies to your entire refund. Even if only part of your refund is from EIC-CTC, the whole thing is held until at least mid-February. This law, called the PATH Act, was implemented to give the IRS more time to detect and prevent fraudulent claims related to these refundable credits.
So if you file early hoping for a quick refund and claim EIC, don't expect it before mid-February at the earliest. That's a good heads up.
Definitely helps manage expectations. Plan accordingly.
Now, the other side of the coin.
Yeah.
What if, after all this, you find yourself owing money? What are the payment options?
The IRS actually offers quite a few convenient ways to pay your tax bill. The easiest and often recommended method is IRS Direct Pay, available on irs.gov or the IRS2Go app. You can pay directly from your bank account, checking or savings, for free.
Direct pay from bank account, free.
Okay. You can also pay using a debit card, credit card, or a digital wallet like PayPal or Venmo. However, these payments go through third-party payment processors who typically charge a fee based on the payment amount.
Card or digital wallet, but with a fee.
Right. Another option is electronic funds withdrawal, EFW, which you can schedule when you file your federal taxes electronically using tax software or through a tax professional. The payment comes directly from your bank account on the date you specify.
Schedule payment when e-filing.
Yeah.
Convenient.
There's also the Electronic Federal Tax Payment System, EFTPS. This is a secure government system, great for businesses or individuals making estimated tax payments, but it requires enrollment beforehand.
EFTPS needs enrollment, good for estimateds. What about old school methods?
Still available. You can mail a check or money order payable to the U.S. Treasury along with a payment voucher. Form 1040-V. You can also pay with cash up to a certain limit at thousands of participating retail stores like Walmart or Walgreens using a payment barcode obtained online. And for large amounts, same-day wire transfers from your bank are possible, though your bank might charge a fee.
Check. Cash at retailers, wire transfer, lots of options. What's generally considered safest?
Electronic payments like Direct Pay or EFW are generally considered the safest, most secure, and provide easy confirmation that your payment was received.
Good advice. Now the tough question. What if someone simply can't pay the full amount they owe right away? That could be incredibly stressful.
It can be, but ignoring it is the worst thing to do. The IRS has options available for taxpayers who are struggling. Don't panic, communicate.
Okay, what are the main options if you can't pay in full by the deadline?
First, you might qualify for a short-term payment plan up to 180 days, often with fewer fees than longer plans. If you need more time, you can apply for an online payment agreement, OPA, at irs.gov OPA. This allows you to make monthly installment payments for up to 72 months.
Online payment agreement for monthly payments? Is it hard to qualify?
There are criteria, but many taxpayers qualify, especially if the amount owed is under a certain threshold, like $50,000 combined tax, penalties, and interest. You get immediate notification if your online application is approved. It's much better than letting penalties and interest pile up without a plan.
Definitely. What if even monthly payments are impossible due to severe financial hardship?
In truly difficult situations, you might explore an offer in compromise, or OIC. An OIC allows certain taxpayers to resolve their tax liability with the IRS for a lower amount than what they originally owed.
Settle for less. That sounds potentially huge. Is it common?
It's not guaranteed and depends heavily on your ability to pay, income, expenses, and the equity of your assets. The IRS has an offer and compromise pre-qualifier tool at irs.gov via OIC that can help you see if you might be eligible before you go through the full application process. It's for situations of genuine economic hardship.
OIC pre-qualifier tool to check eligibility.
Mhm.
Good resources. What about if you need to change a return you already filed? Maybe you found an error or missed claiming the EIC.
That requires filing an amended return, which is Form 1040X, Amended U.S. Individual Income Tax Return. You can find information and the form at irs.gov Form 1040X. You generally have 3 years from the date you filed your original return, or 2 years from the date you paid the tax, whichever is later, to file Form 1040X to claim a credit or refund.
Form 1040X for amendments. Can you track its status?
Yes, there's a Where's My Amended Return tool online at irs.gov WMAR. But be patient, amended returns are processed manually and can take quite a while, often up to 16 weeks or even longer.
Up to 16 weeks or more for amended returns. Good to know.
Yeah.
And what if you just receive a notice or letter from the IRS that you don't understand?
Don't ignore it. Visit irs.gov notices. You can often find information about the specific notice number you received, explaining what it means and what steps you need to take to respond. Responding promptly is always best.
irs.gov notices for help understanding letters. Okay, this has been incredibly thorough.
We've covered a lot of ground.
We really have. We've taken a truly deep dive into the Earned Income Credit today, haven't we? From its basic definition as that powerful refundable tax credit to the very intricate rules of eligibility, those 7 universal rules, the specific tests for having a qualifying child, navigating those tricky tiebreaker rules, and the conditions for the self-only EIC.
We definitely got into the weeds on the rules. And how to figure the credit, importantly.
Yes, figuring and claiming it using the worksheets and tables. And we explored essential resources for getting free tax help and avoiding those common pitfalls, like disallowance and the need for Form 8862, which could cost you money or future credits.
It really boils down to this. Understanding credits like the EIC isn't just about ticking boxes on a form during tax season. It's actually a fundamental part of smart financial management throughout the year.
How so?
It's about being proactive, knowing what you're potentially eligible for, keeping good records, and actively claiming what you're entitled to. For many working individuals and families, the EIC can be the largest lump sum of cash they receive all year. It can make a huge difference paying off debt, building savings, cutting essential expenses. It's not just tax stuff, it's financial well-being.
That's a great perspective. It's about actively managing your finances to claim benefits designed to support you.
Precisely. It's about utilizing every opportunity to maximize your tax savings and improve your financial picture.
So, based on everything we've discussed, we strongly encourage you, the listener, if any of this sounded like it might apply to you, please visit irs.gov EITC. That's the main EIC page on the IRS website.
Yes, irs.gov EITC. Use that EITC qualification assistant tool we mentioned. It's a quick check.
And definitely explore those free tax preparation services, Direct File, Free File, VII, TCE, if you think you might qualify for the credit but feel unsure about navigating the forms yourself. Let the experts help for free.
Absolutely. Don't leave money on the table because the rules seem complicated. Help is available. Remember, knowledge truly is power, especially when it comes to your hard-earned money.
Couldn't agree more.
And maybe consider this as we wrap up. In an era where, let's face it, information overload is constant, and even tax forms can sometimes feel like reading a foreign language, what other simple, often overlooked financial insights might be waiting for you, hidden in plain sight?
Interesting thought. Like other credits or deductions people miss?
Perhaps. Or maybe different ways to manage savings or understand benefits available to you. Insights that could, like understanding the EIC, similarly transform your financial well-being if you just knew where to look or what questions to ask. What other deep dive should we embark on together to unlock those hidden financial benefits?
Something for all of us to think about. Great stuff today.
Always a pleasure.
Until next time.